Hey guys, James here with Waterford Business Solutions. And now that we're full on in tax season, and we're sitting honestly just a month away from business returns, your 1120S's and 1065s being due, we wanted to take a minute to kind of talk about the difference in taxation and how taxes work for different business types. Because depending on the forms you file and the incorporation that you have and or the elections that you have under that incorporation could determine what form you file and or how you pay taxes with your company. So it is honestly highly convoluted. So we wanted to take a quick moment to talk just about that on this week's video. If you're still not ready for taxes and it's 2026 and you still need your books fixed or you still have questions in order to get your taxes filed, it's not too late to go ahead and get everything in order. Go ahead and feel free to give us a call at 864-351-0852 or shoot us an email at info@waterfordbusiness.com, and we'd be happy to set up a free tax consult for you or an initial consult to go over where your books currently stand and how to get them cleaned up to hopefully still get your company's taxes filed on time. Now, going into the different tax areas, we'll start with, quite frankly, the easiest. A C corporation filing an 1120. A C corporation with an 1120, that is the only business entity type that they have to pay taxes directly, both federally and state. As an 1120 or a filer and or a C corporation, you would have a potential federal tax liability that the business actually owes. This isn't any type of pass-through entity or anything else. There would also be a state tax liability. However, moving out of that area and moving into even being a C corporation with an S-Corp election, as that is an option. So either being a C Corp with an S-Corp election, being an S corporation altogether, or being an LLC with an S corporation election. So that means you're going to file an 1120S. So it'll have that S on the end. That now becomes a pass-through entity. Federally, your business would owe no taxes at all. Federally, all of the income that the business has will get passed through and pushed onto the ownership of the company there. Then, state-wise, it'll depend on each state. So depending on the amount of income you have in a state like Texas, you might have some tax liability for the business there, or California, they will have tax liability in California, even when we go into states like Oregon or New York or New Jersey. But federally, the business would never have any tax liability, as all of the tax liability would end up being passed to the ownership through the K-1s on the tax return there. That ownership will take the K-1s that they are provided, add it to their personal tax return, and pay whatever federal income taxes and or state income taxes, for most states, not all states, but most states, any state income taxes would be paid on the owner's 1040 tax return. And technically, this is all the owner's tax liability. The business can pay for the tax liability, but it would not be a business expense. It would ultimately be a owner's draw to pay that tax liability if you choose to use the business to pay for that tax liability. So that's super, super, super important to keep in mind. I see this confusion all the time with S-Corp or 1120S filers. They expense or put the tax expense on the books as an expense. They go ahead and act like they don't personally have to pay it. They pay it in incorrectly, and then they get letters because they haven't paid it in. They paid it in under their business. They didn't pay it in under their personal. And so then they get letters and penalties for not paying it in correctly. So If you're filing an 1120S, you need to make sure estimated tax payments, federal tax payments, most state tax payments are being done by the actual ownership of the company, not the company. And the actual tax rates, unlike with an 1120, will be dependent on the ownership's tax brackets. So super important to remember and consider that is while with a C corporation or an 1120 filer, there's a standard tax rate that any C corporation is going to pay. With an 1120S, that rate is fully dependent on the ownership and what the ownership's tax brackets are. Moving down to a 1065, it is going to work the exact same way as an 1120S. So if you've got a partnership, a multi-member LLC, a limited liability partnership, a business that's unincorporated but has multiple partners, that's going to be what's filing a 1065. With that 1065, it works the same way as the 1120S. All of the business income is going to be reported to the ownership of the company on a K1. The ownership of that company will claim that business income on their personal return, on their 1040. They'll go ahead and pay whatever federal income taxes are due there. They'll pay, in most states, whatever state income taxes are due there. However, the difference between a 1065 and an 1120S is a 1065 is, in addition to the income taxes, also going to have to pay the 15.5% self-employment taxes covering Medicare and Social Security on any type of business income up to a certain dollar threshold. It's all dependent on the amount of W-2 income you have, or basically how much money you paid in already to Social Security and Medicare. So it is kind of a case-by-case basis here, and they do move that needle every single year. But this is one of the big reasons why, as a business, making that S-Corp election or being an 1120S is favorable to a lot of businesses. Now, if you've got a question or if you want to see if that's right for you, we've done videos in the past on exactly what that is, what it means, what you need to do to set up for that 1120S. And it's important to remember we're rapidly approaching the deadline for 2026 here to put that election in if you want to take advantage of that for 2026 and forward, as that is required to be done in general by the 15th of March every single year to be able to take advantage of that election for the current tax year. So again, 1065s, they're going to pass through the income to the business ownership, and the ownership, based off of their tax bracket, will pay whatever income tax and whatever self-employment tax is owed there. Any type of, again, if the business is drawing or the ownership is drawing from the business or taking from the business to pay these liabilities, that is not an expense on the business. It's not a liability on the business. It is an owner's draw to cover that liability. Moving to a standard LLC, single member LLC, a regular business, anything like that, these are going to be people who are filing a Schedule C. Now, a Schedule C is not a completely wholly separate tax return. The Schedule C is something that you add on to your 1040 tax return. That is going to be what you use to claim any type of business income for a sole proprietorship, an unincorporated business with only one owner, or a disregarded entity where the owner are husband and wife, are married, or a situation where it's an LLC but a single member LLC. That's going to be when we file a Schedule C. It works pretty much the same way as a 1065, but whereas a 1065 is splitting the income up between multiple different people and multiple different tax returns and providing that K1 to split that up between the multiple people, a Schedule C on your 1040, that is all of the income, all of the expenses, all of the net profit is claimed by one person. when we go through that, just like with the 1065, the ownership is going to be responsible for paying the federal and state income taxes. The self-employment taxes, that 15.5%, will be the ownership's responsibility. No tax liability will be the responsibility or expense or liability of the business itself. And all of the tax liability, the brackets, the percentages, that's all going to be determined by the ownership in that sole proprietor's tax bracket. So if they're in the 22% tax bracket, that's the rate that their income, the business income, will be taxed. If they're in the 35%, if they're in the 10%, so on and so forth. That is how that will work there in order to keep everything kosher. That's how it is written in tax law and how it works overall. Now, there are different ways, like the S-Corp election, that an LLC can take to better the tax outlook, but this is kind of an overview of how your company is taxed, and more importantly, when the taxes are the corporate responsibility and when they're the personal or ownership responsibility. So as a quick highlight, the only return, the only business that ever has a corporate tax liability or a corporate tax expense is going to be a C-Corp or an 1120 filer. All other forms, 1120S's, 1065, Schedule C's, all of those, the business has no tax expense or tax liability. That would all fall under the ownership, and the taxation is determined based off of the ownership's tax bracket. If you're looking for more tax advice or some more tax explanations just like this, stick with us through this tax season. We've got multiple different tax jobs or tax videos set up for the coming weeks here. We put out a video every single Monday so that we can help you. And even after tax season, we try to cover tax strategies, tax savings, but also understanding your business accounting, understanding your business finances, and so many other areas. So if you truly want to become a master of your money and a master of your company's finances, go ahead and like and subscribe to our channel here on YouTube, turn on notifications, and if you feel like you need personalized help, please don't hesitate to reach out to us here by email at info@waterfordbusiness.com or giving us a call at 864-351-0852, and we'd be happy to work and try to explain anything and everything we can to you so that you can finally understand your business's finances.